Hello friend, welcome to my new video on trade finance. So we will discuss in this video about import and export, and after that we will discuss how many type of payment methods used in international trade finance. So what you think about the export? So export are the goods and services a country produce the domestically and sales to businesses or customers who reside in a foreign country. This result is an influx of funds to the country that is selling their goods and services. Companies may choose to export their product or and services to a foreign country because it allow them to participate in global trade, access new market, and increase revenues. So now let's discuss what is the import. So import are the goods and services a business and customer purchase from the another country. This result is an outflow of funds from the country that is purchasing foreign goods and services. While most countries are trying to export more goods and services than they are import to increase their domestic revenue. A high level of import can indicate a growing economy. This is especially true if the imports are mainly produce assets such equipment and machinery in receiving the country is these assets are more important. So why are export and imports impact? Export and imports are impact because together they make up a country balance of trade, which can impact an economy overall health. In the healthy economy, both import and export see the continuous growth. This usually represents a sustainable and a strong economy. When export and import become the unbalance, it can cause either the trade surplus or the trade deficit. So now we will discuss method of payment. There are five method of payments used in international trade. Uh, First, cash in advance. Second, letter of credit. Third, documentary collection. Fourth, open account. And fifth, consignment. So most secured payment for exporter is cash in advance, and for importers consignment is the most secured, and less secured for cash in advance for importer and consignment for exporter. What is cash in advance? When importers forward the payment to the exporters before coming the goods in importer country, it is called cash in advance, and it may be the payment can be forwarded via credit card, via debit card, via net banking, via TT transmit. And second method is letter of credit. The letter of credit are one of the most secure instrument available to the international trade. An LC is a commitment by a bank on behalf of the buyers that the payment will be made to the exporter provided that the terms and the condition stated in the credit have been complied. So let know third payment of method is documentary collection. So what is the documentary collection? Documentary collection, when an exporter forward the document to their bank, that bank is called remitting bank, and that bank is forwarded the document to the collecting bank, which is the importer bank, and importer bank will collect the document from the remitting bank and forward the document to the buyer and take the money from the buyer, and it may be the site payment, it may be the usance payment. If it is side payment, then importer bank, collecting bank will collect the money and give the document to the importer, document against acceptance. In these situations, the collecting bank will collect the acceptance from the importers and give the document to the importers. Once the document are give to the importers, the collecting bank have to send the acceptance to the remitting bank, and bank doesn't have any responsibility in this method. Fourth method of payment is open account. Under open account transaction, the exporters first have to export the goods, and importer, after receiving the goods, have to make the payment. So this method of payment are used only when the importer and exporter each other have the good understanding and good relationship. So here exporter have very risks, because if the exporter ship the goods and importer denied the payment, so here no guarantee and no bank are involved. So in these situations, the exporter can lose their payment. And importer have very beneficial in this open account transaction, because importer have sufficient time to make the payment. It may be the 30 days, 60 days, 90 days, and after receiving the goods, the importers will make the payment to the exporter. Fifth one is consignment. So consignment is international trade, is a variation of the open account, in which the payment is sent to the exporters only after the goods have been sold by the foreign distributor or agent to the end customer. The international consignment transaction is based on the contractual agreement in which the foreign distribution receive the managing and sells the goods to the exporters, who retain the title of the goods until they are sold. Clearly, exporters on consignment is very risky, and exporter is not guaranteed any payment, and its goods are the foreign country in the handed of the independent distributor or agent. The consignment help the exporters becomes the more competitive on the basis of the better availability and fast delivery of the goods. Selling on the consignment can also help the exporter reduce the direct cost of storing and managing inventory. The key of success of exporting on the consignment is to the partner with the reputed and trustworthy foreign distributor or agent or third party logistic providers. Appropriate insurance should be in place to cover the consignment goods in transit or in positions of the foreign distributor, as well as to mitigate the risks on payment. So you understand the type of payment methods. Now we will discuss one payment methods in upcoming videos, that is UCP. So we will discuss all the articles, and after that we will discuss ISP 98 and URR. So you can subscribe my channels and continue to watching my videos on UCP.